Hey everyone, John Henry here, Slingshot Futures Trading Group. Thanks for joining us in today's video. Before we start, make sure to subscribe to our channel so you don't miss out on any future content. While you're here, give our video a like, make sure to leave us a comment below with any questions you may have and suggestions for upcoming videos. If you'd like a more in-depth look in our trading day, we would love for you to join us in our live trade room for 3 days. It's totally free. It's a free 3-day trial, and the registration for that can be found in the description, or you can simply visit ssftg.com. So let's jump into the video. So the topic for today's video is how to trade when probabilities fail. And we've all been there, right? We know when the trades are working great and everything's going hunky-dory, then straightforward, there's not really a whole lot to talk about. But generally, if you look at the market without context, if I were to just place a trade any old location and just hope and pray that something happens, generally speaking, I'm going to be about 50-50. My accuracy is not going to be very good because realistically, there's no context. There's nothing backing the move. It's just placing a random trade in a random place. The best you can expect is a 50-50 outcome. But here's where it gets a little bit interesting, because with context, when everything lines up, when it's in the right location, you've got the right entry pattern, everything is ready to rock and roll. With context, the probability jumps to 60-40. That 10% jump is all the difference. And really, when it comes to the context, that comes down to understanding the location and what the market is, quote unquote, supposed to do. But as we all know, what the market is supposed to do doesn't necessarily always happen. And that's the other side of the probability. So what do we do when the market didn't do what it was supposed to do? Well, first of all, we have to determine what the market was supposed to do in the first place. And that usually comes down to context. As an example, if I back up the chart over here, you would look at this and think probably, or at least very likely, bullish. I want to be a buyer. Right? I want to be a buyer on the pullback, buy the dip, buy the wedge breakout, whatever your entry methodology is. The market's obviously screaming higher. So the likely context-driven result would be up. Right? I don't know how far up, but I do know that buyers are probably targeting back up towards the highs at the very least, or at least the high closes, something further up than where it is right now. So that's what's supposed to happen, because that's what would make sense to happen. The probability would dictate that the market's going to go up. And in all rights and regards, it tried. It tried really, really hard. But then everything kind of fell apart, and it looked like it was going to get absolutely obliterated here. But when the buyers stepped back in, they shoved it right back up. And that's going to drive a lot of context for the buyers. A lot of buyers are going to be thinking, whoa, wait a minute. This thing looked like it was just going to bottom out and fall through the floor. And now we're all the way back up here again? Wow, man, if they start holding higher lows, chances are buyers are going to be really trying to get that move going back to the upside again. So knowing that buyers are trying to push here, the likely objective, if we start seeing buyers succeed and reasons to believe that buyers are attempting to come in, then this move up should go back up to the highs. But it kind of falls on its face and starts turning down, tries going up again, really strong move, and then gets buried again. So we're not getting that follow through that a lot of buyers are expecting to get going. And you can see, look how strong the bull bars are. And there's a little bit of follow through, and then it just kind of craps out again. So it's not doing what it's supposed to do, but we haven't broken down yet. And that's the key to a true probability fail scenario, when it just completely breaks out. And you can see that that side of trade, in this case, the buyers, will have just flat out given up, right? It's just, okay, it's not working. Time to cut it and go to the next one. And here is where it really gets messy, because we break above a new high. We've seen this several times before, and it failed all the way down to a new low. And now we just had the same thing happen again. So a lot of traders are going to be watching this thinking, well, wait a minute, the buyers aren't getting the job done. That's obvious enough. If the sellers start coming in here, there could be a reason to believe the sellers want to try to drive it lower. And we start seeing more continuation to the downside until we break out to a new low. Now, the new low doesn't necessarily mean that the buyers have given up. We saw that before. They dipped way down here and the buyers rallied it back up. What we need to see is, okay, on this big drive lower, does it do the same thing that it did last time? Does it just go ripping right back up to the highs? Or does it fall apart? Well, that's not a good sign. And then, well, we get the breakdown. Now, when we get the breakdown here, this is where things are a little bit choppy sloppy, because inside of this whole area, you can see buyers are still trying to accumulate. Hold the market up, hold the market up, hold the market up. And then right there, That's where everybody gave up. Now, how do we know that that's where everybody gave up? Arguably, you could say that buyers gave up here. You could say that buyers gave up here. That would be realistic. But what we're looking at here is trying to figure out, okay, when is it just really obvious that something went wrong? It's very obvious that something went wrong when they failed to break above the highs. And that rejection back to the downside is what we're going to be looking to measure up. Because when the probability does something that it wasn't supposed to do, the low probability succeeds, it usually will react with 2 or more legs. Now, what do I mean by legs? What I mean by that is measuring the surprise, the initial surprise move. That's what we're going to use to find out the projection. The surprise move, buyers will have wanted to see that break up, and it didn't. So when it broke down again, that whole drive lower is that surprise move. And you could say that this was a surprise move. That's when they obviously gave up. But realistically, when we have this kind of movement, it's pretty obvious that that's where it all went wrong. That's where everybody gave up. So this drive down becomes a major objective. Not the first move down, but the ability to project this move down to go a little bit further and see, okay, how far does this actually want to go? So we can take this from a measured move perspective. We have the impulse leg, the surprise move. Now we're looking to project that out as a target, as an objective. And you can see as soon as it hit it, it bounced off of it. They did chop through it again, but there was a huge amount of support there. And that's to be expected. Usually when the market does what it's not supposed to do, quote unquote supposed to do, there's usually a 2-legged move. Now we've talked about this millions of times. Well, I don't know about millions, but thousands of times, in that the market moves in 2s. That's what it does. Sometimes 3s, but usually 2s. You get that initial drive, the pullback, second drive. Sometimes it'll fail with the third, and then you get the 3 press tops and all that fun stuff. But the big movement, the underlying aspect of the markets, are that it moves in 2s, and that's just what it does over and over and over and over again. And once you kind of understand that the market moves in 2s, that makes it a little bit easier to kind of figure out where it wants to go. And when you're looking at a probability breakdown, it's the exact same thing. You're just trying to hunt out where the potential area of interest becomes, and then wait for the market to get to that area of interest and see, are you right? Do the buyers actually want to come in and show support there? And if they do, then you've got some reasons to buy a little bit later on. That's all it comes down to. It's just trying to figure out where that extra little 10% comes in, because that's the big difference. Now, obviously, you can skew your probabilities. There's a lot of videos that I've done on probability as well, where the higher the risk, the higher the probability. It just makes sense. But just going from a basic with or without context viewpoint, it's anywhere between 40-60, 50-50, or 60-40. The probabilities don't really range outside of that. Make sure that you are trading them accordingly, so that your math is right and you're not going to lose money in the long run. That's going to do it for this one. Hopefully you found it useful, interesting, entertaining. As always, if you have any questions, feel free to send me an email, jhb@ssftg.com. Until the next one, we'll see y'all then.